pretty much all the signposts for a bubble that we have identified so far are pointing towards no bubble, right? Okay. So if you look at the valuation picture of, say, the Mag 7, so the hottest stocks today versus the hottest stocks in 2000, we're talking they're trading at about half the multiple Microsoft, Cisco, Intel, and Dell, the four horsemen of the internet bubble, were trading at back at the top in 2000. And in fact, the Mag 7's multiple has come down since 2021. So they're growing into their multiple. And you've obviously got a ton of fundamental support here. Earnings running well faster than normal at the end of these melt-up periods. So it's really pointing towards no bubble at the moment.
Okay, that might be the case for the Mag 7, for the companies at the heart of the whole AI revolution. But what about the ones that are kind of on the periphery, on the side, and the profitless tech companies that we talk about that are getting wrapped up in everything?
Yeah, so it's actually interesting you bring up profitless tech. My colleague in BI, Bree Doherty, she does thematics for us. She has a thematics AI universe, and we've actually scanned that entire universe. And we're talking large caps, small caps, micro caps. There's 3 companies in there that are unprofitable in the entire AI universe of, nearly 50 companies. So there's really not a lot of unprofitability, especially within the core AI themes. And that's another just feather in the cap for this not being a bubble.
How about the big tech companies using debt to fund a lot of this?
Question.
Does that raise the radar at all?
Yeah, so it's interesting that they might start dipping into debt markets. That was something that I read this morning on the terminal, actually. But so far, if you look at leverage ratios, right, so total debt to market cap or total debt to EBITDA, those are actually significantly lower than where they were in 2000. And we've frankly been delevering pretty consistently throughout the post-Great Financial Crisis period. So leverage is actually below norms for the S&P 500. For the Russell 2000s, it's pretty much closer to norms. So I'm not that worried about debt financing yet, right? So there's plenty of room for companies to take on debt here.
Why are investors still so worried then? Why are they convinced that this is not sustainable?
Yeah, I think it's a bit of a paranoia, right? We've gone up very far, very fast, and we did look at some previous melt-ups. So we're talking the end of the lead up to the Great Depression cycle, the internet bubble. Those are the classic melt-ups. Our returns have been pretty fast, but they're still falling well short of that. So I think investors are a little bit worried that the returns have been so violent and so quick, and that's adding to a little bit of worry. And of course, worry is a good thing, right? So bubbles usually happen when nobody's worried about them. I like to think about 2000, and people always talk about, my taxi driver was telling me about some internet stock. We're just really not having that right now. There's still plenty of worry in the system, and that's a good thing for a bull market.
Earnings pretty much done with the third quarter here. Are they enough to support this marketplace, do you think?
Yeah, I think earnings were phenomenal, right? There were some obviously bumps in the road on a company-by-company basis, but again, we pretty much doubled the pace of what consensus expectations were. If you look at 2026 expectations, those are holding pretty firm. We're looking at about 13% earnings growth for the year ahead. Again, comparing that to previous bubbles even, that's significantly higher than what we saw at the end. Bubbles are driven by FOMO, not fundamentals. And certainly consensus expectations are strong. And they're actually even strengthening in the Russell 2000, which has been an unloved group for quite some time. So things on the fundamental side looking pretty decent here.
What about on the technical side? I keep reading about how the S&P 500 is still below its 50-day moving average, its short-term trend line, and it briefly fell below the 100-day moving average on Thursday. And because we are not going to get any fundamental data on the economy until after the FOMC decision, earnings season is over, there aren't a whole lot of catalysts from here on out until maybe next year.
Yeah, so one catalyst I'm looking at pretty intently is going to be the holiday spend, right? Like if that comes in a little bit better than we expect, that could be another catalyst for stocks. But certainly you mentioned the FOMC decision. I think a lot of this pullback has to do with Powell's hawkish comments about 2 weeks ago. People just expecting a little more on the rate cut side than what we're going to get. And again, this just looks like a textbook pullback, right? We're down maybe 4 or 5% from all-time highs on the S&P 500. On the Russell, it's approaching correction territory, but still nothing really going as far as a bubble bursting.